Hello learners, in the previous slide or in the previous video, we had learnt about cost of redeemable debt. That means a debt which has a provision for interest payment year on year till the maturity, and at the end of the maturity period, principal amount or the amount promised at the time of issue is repaid to the bondholders. Now, in today's lesson, we learn about cost of perpetual debt, cost of preference share capital and cost of equity. Now, as you know, a company can issue perpetual, that is non-redeemable debt also. However, in practice, as of today, there is no provision for issuing non-redeemable debt, but in theory we always learn about this concept. Now, what is a non-redeemable or perpetual debt? A perpetual debt is the one in which year on year company has a provision for interest payment till the lifetime of the company. That means these debentures have no maturity provision, and in that case, how do we calculate cost of debt? Formula is simple. How we will be calculating, or how the cost of perpetual debt will be calculated? So, cost of perpetual debt pre-tax, that is before tax, is calculated by using this handy formula, I upon P multiplied by 100 will get you the answer directly in percentage. Now, what is I in this case? I is the coupon payment or interest payment every year by the company, and P is the net issue proceeds, as it was in the previous slide also or in the previous video also, that is issue price minus flotation cost. And this before tax cost when multiplied with 1 minus TC will help you in getting after tax cost. So, calculation of after tax cost fundamental is the same as we had in the previous video. Only before tax cost for non-redeemable debt is calculated like this. Let us practice one numerical on that one. Let us assume that 16% face value 500 bonds issued at 3% premium. Flotation cost by company is 1%. If tax rate is 30%, calculate cost of these debentures. So, in this case 16% is the coupon rate. That means to say on par value of 500. So, just to remind you, interest, dividend, premium, discount, every calculation is done on the par value. So, I will be 16% of 500 to be paid by company year on year. Since there is no maturity, so these do not have any maturity provision. Then what is the issue price? Issued at 3% premium. So, calculate 3% on par value. So, these will be issued at a premium of 15. So, issue price will be 15 plus 500, that will be 515. 500 is the par value and 3% is the premium. And flotation cost. So, flotation cost is also the function of par value. So, rupees 5, 1% of 500 will be the flotation cost. So, how much P we get it? 515 minus 5, we get it 510. Now, we can calculate cost of debt before tax 80 divided by 510. If you multiply straightway with 100, you will get the answer in percentage. So, 80 upon 510, we get it 15.68%. That is before tax cost. Same before tax cost can be converted into after tax cost, that is KD before tax multiplied with 1 minus TC. So, we get it 15.68 multiplied with 1 minus 0.30. So, what we get? 15.68 multiplied with 0.7, we get it 10.98%. So, that is how cost of perpetual debt or non-redeemable debt is calculated. So, only maturity provision is not there. So, just to remind you, in an examination question, if maturity provision is not given, such kind of debt is known as perpetual debt. Then we proceed for the calculation of cost of preference shares. Now, when we have to calculate cost of preference share capital, in case of preference share capital also, we can have two kind of preference shares, redeemable and perpetual. Redeemable preference shares are the one in which company will pay fixed percentage of dividend year on year till maturity, and on maturity principal amount or the promised amount will be returned back. Perpetual will be the one every year company will pay the dividend till the lifetime of the company. Now, for the calculation of cost of preference share capital, fundamental is simple. Just remember the fundamental of cost of debt. How we calculated cost of debt? Now, what was the formula for calculating KD before tax, that is pre-tax, in case of redeemable? Same formula will be applied here, but that formula will be cost of preference share after tax. So, I am writing the formula of KD pre-tax first. So, we had a formula like this, I plus MV minus P divided by N, then M plus P, MV plus P divided by 2. By using this formula, we calculated pre-tax cost of debt. Now, the same formula can be used for calculating KP, post tax. Only change will be there, I will be replaced by D, rest of the parameters will remain the same. So, it will be D plus MV minus P divided by N, MV plus P divided by 2. Now, as you can see, D is dividend amount per year to be paid by the company on preference shares. MV is the maturity value, as we had in case of debentures. Similarly, we will calculate maturity value of preference shares. P is the net issue proceeds, that is issue price minus flotation cost, and N is the maturity duration. So, simply by using the same formula, we calculate post-tax cost of debt, or we calculate post-tax cost of preference shares. Only change we have taken, I is replaced by D, rest of the parameters are the same. Now, why this formula gets me post-tax cost of preference share capital? As we know, dividend is paid out of after-tax income of the company. Therefore, dividend payment does not get the tax shield for the company, tax benefit for the company. Hence, this formula gets me cost of preference share capital after tax. Similarly, for perpetual one, KP, after tax can be calculated D upon P multiplied by 100. This will be after tax. So, dear learners, same fundamentals are there, same numerical you can pick up, only thing will be there, take care, instead of debenture, if word is preference share, you can apply the formula like this and calculate cost of preference share capital. So far we have learnt about cost of debentures and cost of preference share capital. Now let us proceed further with the next fundamental, that is cost of equity share capital. Cost of equity capital. Now as you can see, in case of equity shares, company has no direct and implied obligation to pay the fixed dividend. Rather, equity shares do not qualify for any kind of fixed dividend payment. Rather, dividend payment might change from year to year. So it is defined as the minimum rate of return that a company must earn on the equity funded portion of an investment project so as to leave the market price of the shares unchanged. There is no direct method of calculating cost of equity capital. However, equity shareholders capitalization rate is like a proxy for the cost of equity capital. That means to say, in an implied manner or indirectly, we can calculate cost of equity share capital by taking into consideration investors' expectation or investors' capitalization rate. Now, how that is implied, let us proceed further. Cost of equity can be calculated using any of these two approaches. Many of the people refer this as the fundamental approach and this refer as the market based approach. However, more popularly, dividend capitalization model or capital asset pricing model, both are used in practice equally in the market. So dividend valuation or dividend capitalization approach. Accordingly, cost of equity capital is defined as the discount rate which equates the present value of all expected future dividends from the equity with the sales proceeds of the equity or the current market price. Now, what are the assumptions of this particular one? Assumption is simple, or assumptions are as we had in the case of Gordon's growth model, that if suppose we are calculating cost of equity today, the immediate next dividend will be paid after 1 year. So D1 can be calculated D0 multiplied with 1 plus G. I hope you remember the fundamentals of valuation of equity shares, same fundamentals are there. So immediate next dividend will come after 1 year. Dividends are likely to be paid every year till infinity. There is no break in between, and dividends might change or grow at a constant rate of growth. Given these fundamentals, we can calculate cost of equity share capital by using dividend capitalization approach. Now, if those fundamentals or assumptions are met, then what are the things we have to keep into consideration? By using this formula, we can calculate cost of equity share capital. Although this is the final formula for the learners to be remembered for calculating cost of equity. So originally, what particular thing is being shown? We are calculating present value of all future expected dividend by using a particular discount rate, because we said cost of equity is such a discount rate at which present value of all future dividends equates with the current market price or the net issue proceeds in case of new issue. So now if you simplify this particular equation, we get this equation first, and I hope you remember this was the equation we used in the valuation of equity share capital or equity shares. Same thing can be converted into to find out the unknown value of KE given P0. P0 is referred as current market price of the share, or in case of new issue it will be net issue proceeds, that is issue price minus the flotation cost. So parameters are given, only one attention you have to pay while solving the numerical. Are we given D1 or D0? If D0 is given, we can convert that into D1. So D0 multiplied with 1 plus G will get you D1. It means we can have one formula like this also, KE is equal to D0 multiplied with 1 plus G divided by P0 plus G. So, use any formula, ultimately it is mathematics which will lead you to the answer of cost of equity. KE stands for cost of equity, and remind you, cost of equity is always after tax, because dividends are paid out of the after tax income of the company. There is no tax benefit to the company on paying dividends. So, if we can take an example, current dividend per share is rupees 20 and it is likely to grow at a constant rate of 9% per annum forever. If current market price of a share is 160, then find out cost of equity share capital. So, in this case what we have, D0 is given 20, constant growth rate is given 9%, which is written as 0.09, and P0, which is CMP, is 160. So, use the formula KE equals to D0 multiplied with 1 plus G divided by P0 plus G. If you plug in the values, 20 multiplied with 1.09 divided by 160 plus 0.09, what we get? 20 multiplied with 1.09 gets me 21.8 divided by 160 plus 0.09. So, we get an answer 0.22.63, that is cost of equity in this case is 22.63%. So, that is how, by using this handy formula or a small formula, we can calculate cost of equity capital by using dividend capitalization approach. Let us proceed further. I hope you have seen the parameters, you remember the formula, and like this we can solve it out. Now, taking the data of the same numerical, what is there if suppose current market price of the share is 160, but now company is going to issue the new shares, because companies can issue new shares also, and in that case shares will be issued at a price of 150 and flotation cost per share is rupees 2. So, how do we calculate cost of equity? So, in that case KE will be same formula, D0 multiplied with 1 plus G divided by P0 plus G. Now, in this case P0 is nothing else but net issue proceeds, that is issue price minus flotation cost. So, at what price company is going to issue the equity? 150, that is new equity shares, and on every share company will spend 2 rupees as the flotation cost. So, instead of 160 which we used in the previous solution, we will be using 148. So, KE in this case is simply 20 times 1.09 divided by 148 plus 0.09. So, what we get? 21.8 divided by 148 plus 0.09. So, we get 23.73%. So, we can say for this company existing cost of capital was the one which we calculated in the previous slide, and cost of new issue or new equity is 23.73%. So, you have to pay the attention. For the existing one, use current market price, and for the new issue use net issue proceeds, which is issue price minus the flotation cost. So, similarly one more example we have, we can see that example also. Current market price of face value rupees 10 share is 450. For the next year expected dividend is likely to be 45%. So, I will take you to the previous slide, how the numerical has changed. In the previous case, dividend given was the current dividend, that was D0, but in this case what we have been given? We are given something different. Now what is that different? We are given expected dividend for the next year. That means by applying this percentage, we will be getting the D1 directly. Now always remember, dividend percentage is the function of face value. So what is the par value of this equity share? So current market price of face value 10. So face value is 10. So we can get D1, 10 multiplied by 45%. That means next year's expected dividend is 4.5. So always remember, dividend percentage is the function of par value. P0 is given 450. Dividends are likely to grow at a constant rate of 6% year on year till infinity. So simply all the parameters are there with you. You can apply the fundamentals and calculate cost of equity. So cost of equity will be 4.5. We are straightway given next year's dividend. So we are using the formula for cost of equity like this: D1 upon P0 plus G. So P0 is 450 plus 0.06. So what we are going to get? We are going to get it 4.5 divided by 450 gets me 1%. So it becomes 7%. So we can say in this case cost of equity is 7%. So always you have to be attentive whether D0 is given or D1 is given. Apply the dividend percentage on the par value or the face value. So that was dividend capitalization approach. So we have learnt about dividend capitalization approach. Now we will be proceeding further with the capital asset pricing model. Now what is CAPM? Now capital asset pricing model practically is used for the valuation of the equity shares, or it is a parameter used to indicate whether a particular share is overpriced or underpriced or efficiently priced. However, same CAPM fundamental can be used to calculate cost of equity also. Now how it is calculated? So CAPM approach is based upon risk-free rate of return and systematic risk of the shares represented by beta of the share. Now as you know, when we make an investment in the market, there is something called as risk-free investment avenue, and the rate of return associated with that risk-free investment avenue is risk-free rate of return. So generally government bonds or treasury bills are considered as risk-free investment avenues. So return on that is called as risk-free rate of return. And always remember what we are calculating under CAPM, how much returns are being expected by the equity shareholders while making an investment in a particular equity share. And that is what is the cost of capital. We started with the definition. In an implied manner, cost of equity is nothing but the return expected by the shareholders while making investment in the company. And that becomes indirect obligation for the company that yes, company must earn minimum that much return on its investment projects so as to keep the equity share price unchanged. So cost of capital in that case is based on these two fundamental. That means minimum risk-free rate of return is always expected by the investors while making investment in the equity shares. Apart from that risk-free return, they need some compensation for the systematic risk, which is measured in terms of beta of the equity shares. Now what beta is, we will see in the next slide, but right now you can note down the formula. By using CAPM approach, we will be using this formula to calculate cost of equity. And once again remind you, cost of equity is after tax cost because dividend is paid out of the after tax income of the company. So these are the parameters we will be using while calculating cost of equity using CAPM approach. Now what beta is? It is the sensitivity measurement which tells us the volatility of the return from a particular share towards given volatility of general market index or market portfolio. That means if I say beta of a particular share is 1.75, that simply means if on a particular day market is going up by 1%, return from this share will go up by 1.75%, or if beta is 1.75% and on a one particular day index of the market rises by 5%, then due to its association with the index of the market, return from this particular stock will go up by 1.75 multiplied by 5. So, 1.75 multiplied by 5 gets me 8.75%. So, in that way beta is the volatility measurement which tells me how the return from a particular share will change given volatility of the index of the market. Beta of a share may be positive or negative. So, in that way we calculate or we represent beta as a measure of systematic risk. So, higher the systematic risk in a particular stock, higher will be the expected return by the shareholders. Lower the beta, lower will be the risk or systematic risk, and lower will be the expected return by the shareholders. It means under CAPM approach, cost of equity calculation is all dependent upon the beta of the stock. For high beta stocks, cost of equity will be high because investors are assuming more risk, equity shareholders are assuming more risk, so they expect more return, and indirectly it becomes an obligation for the company to earn more and more, so that share price to be remain unchanged, or rather it should keep on rising. So, low beta means low risk stock, high beta means high risk stock. So, we can take an example. Risk free rate is 4%, beta of a share is 1.25. If market portfolio or index of the market is generating 16% return, then calculate cost of equity share capital. So, we can calculate KE is equal to RF plus beta of the stock multiplied with RM minus RF. Now, this gap between RM and RF, RM is return on the market portfolio or return on the index of the market, and RF is risk free rate. So, this gap is called as market premium or market risk premium. So, in this case market premium is how much? 16 minus 4, that is 12% is the market premium. Beta is 1.25 and risk free rate is 4%. So, what we get? 4 plus 1.25 multiplied with 12. So, we get it 4 plus 15. I hope 1.25 multiplied with 12 will get me 15. So, we can say cost of equity share capital in this case is 19%. So, always remember, in the question we are given 16% as the return on market portfolio, and we have directly applied the formula because RM means return on market portfolio. However, same numerical I can give you like this. Same numerical I can give you like this. Let us say instead of giving you return on market portfolio, what I can give you? I can say this is not given to me. I can say market premium or market risk premium is equal to 12%. So, only one change will be there in the numerical. We are not given return on market portfolio, rather we are given market premium or market risk premium 12%. Calculate cost of equity. Same formula will be there. KE equals to 4 plus 1.25. Now, this time we are straightway given 12, the gap between 16 and 4. So, we can straightway plug in 12, and now we will get the same answer, 19%. So, just pay the attention on the language of the question. If market return is given, use market return minus risk-free return as market premium or market risk premium. Or if language is like this, market risk premium or market premium, then use straightway the same value to calculate KE. So, this is the way CAPM approach can be used for calculating cost of equity capital. So, now we can understand little bit of the things, the theoretical part, that what is the difference between CAPM model and the dividend capitalization model. In CAPM model, we incorporate the concept of risk, whereas under dividend capitalization model, we incorporate the concept of dividend. Flotation cost can be incorporated in the dividend capitalization approach, but not in the CAPM model. Then estimation of beta requires a detailed exercise. We need to have market data, data of the market portfolio, index of the market and all that. So, accordingly it is difficult to apply CAPM, and then estimation of future dividend is difficult as applicable in the dividend capitalization approach, because under dividend capitalization approach we are assuming that company will keep on paying dividend year on year till infinity. That is difficult to estimate. So, these are the theoretical aspects about comparison between these two models. Then lastly we have cost of retained earning. Now, cost of retained earning is calculated in an implied manner, because there is no direct way to calculate cost of retained earning. Now, implied manner is simple. Since retained earning also belongs to equity shareholders, so finally we say whatever is the cost of equity and definitely cost of existing equity, whatever is the cost of existing equity, same is the cost of retained earning. So, you need not to put any extra formula, any extra efforts to find out cost of retained earning, because ultimately retained earning belongs to equity shareholders. So, therefore, whatever equity shareholders are expecting from the money directly contributed in the company, they will expect the same return from the retained earning. So, finally, we say in an implied manner, cost of retained earning is nothing but the cost of existing equity capital. Pay the attention, cost of existing equity. So, that is the way we calculate cost of retained earning, and cost of retained earning is on the principles of opportunity cost of capital, which we explained in the beginning, that what is implied cost. So, that is how we calculate specific cost of debentures, preference shares and equity. I hope you have learned the concept. Now, in the subsequent lesson, we will be going in for the calculation of weighted average cost of capital, as well as we will make some practice on calculation of all these fundamentals, specific cost of all the three parameters, debentures, preference, equity and calculation of weighted average cost of capital. Till then, keep on learning, keep on revising the formula, so that you become comfortable in practicing the question. Thank you.